Hello, everyone. Thank you for joining in today on a Sunday, and thank you for taking out time. And thank you, Ankit. So, I'd like to introduce Mr. Ankit Singhania. He's head of passive business at Edelweiss Mutual Fund. Looks after all their ETFs uh, uh, across asset classes, be it commodities, gold, silver, equity. So he's heading the passive desk at Edelweiss Mutual Fund. Thank you, Ankit, for joining in today. And today we are discussing a very prevalent uh, topic, uh, and it's on everyone's mind uh, about gold and silver. There has been an amazing rally in both the asset classes. Gold, it has been going on for quite long, and silver, particularly for the last 1 year, we have seen an incredible rally. Uh, so, Ankit, you are there, right?
Yeah, I'm there, Ashish.
Right. So, my first question to you is on let's first start with gold. Uh, Around till 2015, 2016, gold was more of a, I would say, still we use it as an hedging asset class. Uh, it's a non-yielding asset class, as we understand, uh, and its price is associated or is linked with a lot of geopolitical global parameters.
True.
V- and we have seen an incredible rally over the last 6, 7 years. What are the reasons for this rally? Uh, there are many kinds of demands for gold. One is on the consumption side, second is on the investment side. So, how are the demand factors work in gold, and what is the long term structural outlook on this asset class moving forward?
Sure. Thank you, Aditya. And thank you for setting the context because, as you correctly mentioned, this is now a hot topic that what is the price of gold and silver and how it is going to be shaping up in future, right? Because I think for the first time in our lives, we have seen this kind of volatility or this kind of rise both these precious metals of gold and silver. Now, coming to the first thing, which is about gold, right? While is it not audible?
Uh, yeah, I can hear you. If you can, still the audio is a little low. If you can just come closer to the
Yeah.
mic.
Is it is
Yeah,
it audible now?
yeah, little better. Uh,
But my mic is on the maximum thing. I mean,
okay.
let
Yeah,
me
please go ahead.
wait. So, is it better now?
Yeah, yeah, little. Yes, better. Please.
Right. So the point that I was trying to make is that you correctly mentioned one point is that the hot discussion as of now is gold and silver, right? Particularly when it comes to gold, there was for the first time we have seen such kind of a movement, such kind of a volatility, and everybody is kind of anticipating what is the next move. And if they want to take an allocation, what should be a right price to enter, right? Now, for that, what we need to understand is, particularly from a gold perspective, is that gold was and always be a store of value. And it was a store of value much before any other asset class even came into existence. Right. So we have to see gold from a very different dynamics. Now, between the all asset classes, say equity, fixed income, and commodity, particularly gold, what we need to understand is that there is a clear objective of each asset class, right? And there is a clear challenge available in each asset class. For example, when it comes to equity, the objective of equity is to generate returns because equity can generate the returns like no other asset class can generate because it is an yielding asset. There is a business associated to it, and as the business grow, your stock prices, your equity prices move. So equity is more from a wealth creation, or if you ask me, for growth. Challenge is that it comes with a lot of volatility. Similarly, if you see fixed income is for providing stability to the portfolio, but the challenge is at times fixed income fails to beat even the inflation. And when it comes to commodity, particularly gold is basically for three things in your portfolio, and they all are associated with more like a hedging thing, which is hedge against inflation over long term, hedge against currency depreciation, and to support your portfolio during periods of uncertainties. And that is the entire role of gold in any portfolio. Right? When we say entire role, which means it is like a more like a value preservation asset class. Right? And in that process, if return is generated, consider that all it as complementary in nature, because the role of gold is very, very clear. Right. Now, coming to the second part of your question, that entry point for the gold or what should be an approach for gold, we need to understand two things here. That is my gold allocation strategic in nature, or the gold allocation that I want to take is tactical in nature. So if you are taking a strategical allocation, which means 10 to 15% of your overall portfolio, you are investing in gold. In that case, I don't think that you need to actually have assessment on any price, because when we say strategic allocation, which means it is more like for hedging, and I think there is no right or wrong entry point for that strategic allocation. However, if you want to come to for a tactical allocation where you want to do a meaningful allocation, in that you have to identify a right price to enter and a right price to exit. For that matter, it is highly unpredictable to identify any correct price to enter or correct price to kind of exit. However, what we can actually discuss is the current dynamics which are available in terms of gold. Now, in case of gold, this is an asset class where you cannot manufacture gold. Can we manufacture gold? No. Which means the entire dynamics of gold prices is depend on the demand and supply. Which means if the demand is more, supply is less, then the prices will rise. Or if the supply is more and demand is less, then the prices will fall. Right? So to understand it better, I have created something. Can you allow me to share a presentation so that I can actually discuss with data and have some interesting data to show?
Sure, sure. Just give me a minute. Are you able to share the presentation?
Let me just see now. No, it's still showing that the host isn't allowing sharing for the meeting. I think I can share it now.
Yeah,
It's visible now, right?
yeah. Also, Ankit, just there would be a record button because I've made you the host, so you can just start the record button.
Okay.
But just besides the participants.
I think it's already recording. I can
Perfect,
only pause
perfect,
it or stop. So I think it's
perfect,
already recording.
perfect.
Right? Now, considering gold in the current scenario, right? For the current scenario, what we need to understand is what is the demand supply dynamics in gold, right? This is the supply trend of gold, and this is for last almost 6 years from Q1 2019 till Q4 2025. So you can see on the supply side, the supply is pretty much flat in the range of 1,000 to 1,250 tons quarter on quarter for last 5 6 years, which means there is no increase in terms of supply, despite prices rising from say $800 to close to $5,000, and now currently they are close to $5,100, which despite this kind of a jump in prices, the supply was pretty much flat, which means this gives a very clear indication that supply is constrained. Basis price, you cannot increase or decrease the supply. The supply is pretty much flat in the range of 4,000 to 4,500 per annum. So this is the total supply of gold for last 5-6 years. 4,000 to 4,500 tons kind of a supply per annum, or 1,000 to 120 tons per quarter. If we go and check the demand trend of the gold, I mean, that demand can be, as Aditya was also mentioning, it can be an investment demand, it can be a central bank demand, or it can be, say, technology demand. So everything put together, if we see from a demand perspective, see, demand is in showing a increasing pattern. And if you see year on year or quarter on quarter, again from Q1 2019 till Q4 2025, the demand is on an average in the range of 1,000 to 1,350 tons for almost last 5-6 years. In fact, in the last 3 years, or in last 8 to 10 quarters, you can see that demand is also showing an increasing trend, which means while supply is constrained, demand is strong, showing a positive trend, which actually makes the story of demand and supply of gold, and that is why it is actually putting a pressure on the price, and that to an upside pressure. Now we might be hearing this story about the central bank, that it is central banks which are driving which are driving the gold prices for last 3 years from 2022, when from where the sanction was put on Russia. Now, if we go and check the current demand dynamics, right, and what is the kind of demand spread in the overall gold case, is that only 21% demand is demand from central banks, 43% is investment demand, 29% is jewelry demand, and 6% is kind of a technology demand, which means it is not central bank alone which are driving prices. It is a composition of investment, consumption, jewelry, technology, and central bank that is driving prices. Again, a very important point here is that everybody is saying that, say, tomorrow central banks start kind of taking a pause on buying more gold, or they can start selling gold. They may do so, but ultimately that is only 21%. So and out of that 21%, it will not impact the entire demand and supply dynamics of gold. It can impact only up to the extent of 21%. Now, we all know that for the last 4-5 years, from 2022 till, say, 2025, 22, 23, 24, 25, every year the central banks actually purchased close to 1,000 tons, which actually makes the story that it is only 20-21%, right? So it will not be the overall thing that will determine the demand for gold. So to understand what actually determine the demand for gold, it is basically the functions or the drivers that drive that gold demand is basically your interest rate outlook, your investment demand, your consumption demand, and demand from central bank. Now, from an interest rate outlook perspective, if you see, whenever we see a falling interest rate scenario, or we enter into a scenario when the interest rate starts decreasing, that is a very, very strong or positive signal for gold, because the gold demand increases. And we have seen that in the recent past, that the mere expectation of a Fed rate cut actually brings some amount of rally to the gold. So in case of interest rate outlook, it is actually negatively correlated with the gold demand, because that is that in the falling interest rate scenario, the demand for gold increases. Now, considering the current situation, we all know that US and in the Indian markets and major part of the global markets, they are closer to the peak of their interest rate scenario, which means if the interest rate has to come down from these levels, which means it is a very, very positive signal for gold, and that gives a very, very strong outlook for gold. Right, and this story is actually working for last 1.5 year, where actually gold moved from close to $3,000 to now close to $5,100. So interest rate is a big supporter of gold at this point of time. The second one is investment demand. When we say investment demand, which means demand in the form of, say, ETFs, gold bars, gold coins, and everything. Now, in this investment demand also, if you see from Q1 2019 till Q4 2025, the demand actually went down when the prices of gold were kind of flat, right? And the demand again improved as the prices start moving. However, we need to understand is where this entire investment demand is coming. This entire investment demand is coming with the growing uncertainty. Now, uncertainty is not current phenomena, uncertainty is actually available in last 5 6 years. It started with COVID-19 pandemic, then we have seen Russia-Ukraine war, then we have seen Israel-Hamas war, then the appointment of Mr. Trump, which created the entire or which he created an entire disorder in the world order, right? So this entire uncertainty demand is growing on that. So if you believe that this uncertainty will be there for some more time, which means there is a good room for kind of gold to move from here, because this uncertainty demand will only increase. Now when we say investment demand is also about strategic allocation and tactical allocation. Now, in the strategic allocation, also, what we say is that 10 to 15% of allocation should be to the gold. Now, take an example of Indian markets. We have close to 80 lakh crore mutual fund industry. I am not even considering the direct equity exposure or FD exposure. Even from a 80 lakh crore mutual fund perspective, if you actually put a 10% allocation to gold there, the total number comes out to be 8 lakh crores. Whereas the total gold ETFs at this point of time is only closer to 1.25 lakh. So even if we have to go there, say for example, from 1% to can kind of say 6 7%, 8%, or from 1 lakh to close to 5 6 lakh, which means there is a very strong investment demand we can expect to kind of Indian markets to bring in terms of gold. Similar is the case for global markets. Currently, the global exposure is close to 6.6%, and they are actually increasing it at all levels, which means even if they are taking it to say 10%, there is a huge investment demand that will come in gold, and that will create a very good story for gold. Now, coming to the third point, which is consumption demand. If we see from a consumption demand perspective, right? From a consumption demand perspective, we believe that since the prices are rising, consumption demand must be weak. But the data suggests otherwise. Now, consumption demand is two types of demand. First is jewelry demand, and the other is technology demand. So everything put together, if you see on an average for last 3 years, the consumption demand on an average is close to 500 tons per quarter, which means the consumption demand is actually very, very strong. Now, see from Q1 2025, the first quarter of calendar year 2025 till the last quarter of calendar year 2025, we have seen the gold prices actually moving from say close to $2,500 to $5,000, but the consumption demand has not decreased. It has further increased. You can see Q1, Q2, Q3, and Q4, right? The last four blocks. So in this, what it shows is that the consumption demand of gold remains strong despite price rise, which makes a very, very interesting story for gold in the current juncture also. So interest rate outlook perspective, gold is looking positive. From an investment demand perspective, gold is looking positive. From a consumption demand perspective, gold is looking positive. And also, if you see the last point, which is demand from central bank, post 2022, on an average, central banks have bought close to 1,000 tons of gold per year. And the same was also available, the same was also kind of visible in the last year, 2025 purchase, where the central bank actually purchased close to 850 tons kind of gold. Now you must have heard that the recent Central Bank of Poland announced that they will buy 750 tons kind of a gold, and they alone will buy 750 tons kind of a gold. And if we put together other demand of other central banks, the number will be huge. So this central bank demand is also positive for kind of a gold. A recent survey, or I'll say the survey done by World Gold Council last year with all the central banks, 72% of central bank confirmed that they have to do major buying of gold going forward. Now, this data will further kind of clarify this to you, and I've taken only top 10, 11 economies here. That if you see US is holding roughly 80% of their total reserves in the form of gold. Germany again 80%, Italy 77%, France 78%, while that number for Russia Federation is only 40%, and that number for China is only 8%. And you can see a shift of what is happening in China. If we see the same number on Q2 2022, when the central banker story started for gold, that was only 4%, which means China in the last 3 years doubled its gold reserve. The same thing is visible in Switzerland, the same thing is visible in Japan, the same thing is visible in India. So while there are some central banks which are holding 80% of their reserves in the gold, there are some central banks which are merely less than 15-20%, and they're increasing, and they're increasing gold at all level. They are buying gold at all level, and you must have heard that China is massively buying gold at all levels to increase or to keep the pace up with the reserves, because going forward it is expected that gold will be universal currency, and people have accepted this concept of de-dollarization. While except dollar, there is no currency that people can trust, or there is no currency which have that kind of acceptability. So what is left is gold. Because if you ask me, I mean, if we simply apply a normal logic, if 100-gram gold coin is same in India and same in Russia or same in Japan or US, while a 500 rupees ka note bundle will have no relevance in Japan, or for that matter in US, until unless you convert it. So that is why gold is increasingly becoming, taking the status of universal currency, and which actually brings a very strong point for gold, right? So everything we put together from a demand supply dynamics perspective, the demand is pretty much strong quarter on quarter for last 5-6 years. Supplies constrained, supplies in the range of 1000 to 1250 tons. Secondly, if we see the factors that affect the demand for gold are all showing positive signals for gold. And the last, and I think very important point is that while we say that close to 5000 tons is the annual demand for gold, the total amount of unearthed gold, when I say unearthed gold, which means they are available in mines, we know that there is gold but we have not extracted it. The total amount of unearthed gold reserve is close to 55,000 tons, which is only as good as a 10-year supply, and after that it will be only trading. So again, the demand supply thing will work, that is that a commodity which is in scarce, and where that there is a huge demand, ultimately the prices will see an upside. But having said that, what we strongly believe is that don't come to investing in gold to make or to chase quick returns. It is more like a strategic asset allocation. Your 10 to 15% allocation should be in gold. And if you are doing a strategic allocation, I think all levels are good levels. In fact, if you see after that, the fall that gold has seen from $5,000 to $5,000, it is actually moving or consolidating in that range between 4,900 to 5,100. On Friday, it actually broke that 5,100 levels, which also gives a very positive signal for gold, because that actually reflects that there are buyers of gold at all level, which is a very positive thing for gold. So this was all that we wanted to kind of discuss from a gold perspective.
Right. And uh, so two, 3 points. One is that there is the supply demand dynamics look favorable. There's the
True.
supply is more of like a constant, where there is a growing demand across investment, consumption, as well as central banks.
Correct.
Second is we have we have a very long history of gold. So it's not just that these last 10 years, but over the last 50 years, gold has proven to be a good hedge against inflation. So gold has always beaten the inflation, though it has
True.
not been yielding uh, equivalent to equity before 10 years. But before 10 years also, it was a good hedge against inflation. So we have a long history of gold uh, to be a good hedge. So there should be a structural allocation in the portfolio. There should be a strategic allocation in the portfolio, but people should not come just because of chasing the recent rally. Uh,
Correct.
just because of the recency effect, people should not come and allocate in gold. It should be a strategic allocation uh, of about 10 to 15%. As an Indian household, we anyways have good allocation of gold through physical metal, but there should be a strategic allocation in the financial portfolio uh, for the purpose of hedging the portfolio against the geopolitical risk, but not for the purpose of chasing past returns. Is that understanding correct?
Yeah, that's the exact understanding we'd like to convey. I mean, you have summarized it very well. Thank you, Aditya.
Right. Also, Ankit, now coming on to the point of uh, what are the methods. So, on the mutual fund side or a financial route, taking an exposure through a financial route, we have two options. One is taking exposure through multi-asset funds.
Hmm.
Second is taking exposure through gold and silver ETFs.
Hmm.
We'll come to silver after this question, but this
Hmm.
is also a very important question where there was a lot of news that paper gold and paper silver or ETF are not same as physical gold or
Correct.
physical silver.
Hmm.
From an Indian ETF point of view, how
Hmm.
much regulated is gold and silver ETF? Whether these gold and silver ETFs are backed by real gold and silver. So
True.
yeah, and so there is a myth that is going on that this is not equivalent to physical one. So if you can clarify that these are backed by real assets, and how regulated are they?
So, so, just to kind of elaborate your point, Aditya, that what are the options through which you can actually invest in gold? While we are clear that we should have a strategic allocation to gold and gold should be part of our overall portfolio, but what are the options available for you to invest in gold? Primarily, there are three options. The first option is that you can take the route of buying actual physical gold. Second is that you can take a route of buying gold ETF, gold fund of fund that is available on the mutual fund side. And the third is that you can take the digital gold, which also claims that we are not
Right,
charging anything and we are giving you gold and all of that, right? So first of all, from a regulatory aspect, while while your physical gold is also not regulated to a larger extent, your digital gold is also not regulated at all. Your gold ETFs and gold funds are kind of very exclusively regulated by SEBI, which clearly mandates that we can create units of gold ETF or silver ETF only after buying actual physical commodity, be it gold and silver, which clarifies that each unit of gold ETF or silver ETF is backed by physical gold and silver. We are not creating anything. We are not creating any units against which there is no gold and silver. So it is 100% backed by gold and silver, whosoever and whatever is claiming, because people are actually taking that reference of global ETFs, global gold ETFs and global silver ETFs, where they are allowed to actually take exposure of paper gold or gold derivatives. In India, we are not being kind of allowed to trade in the commodity derivatives, either gold and silver, and that is why each unit is actually backed by physical gold and silver. And for that, you can also examine the monthly portfolios disclosed by all gold ETF and silver ETF, where they clearly mention that what is the kind of physical holding of gold that they are currently holding in their portfolio, and which normally are in the range of 99.50%, because 0.50% they keep in the form of cash for regular flow management. But 99.50 exposure in both gold ETF and silver ETF are actually backed by actual physical gold and silver. So from a regulatory point of view, it is very clear that while physical gold is also not so regulated, because we have seen instances that despite hallmarking, there are purity issues there where the gold was impure. In digital gold, in fact, SEBI itself issued I think an addendum which says that digital gold is not regulated. If you want to take exposure in gold, please take exposure via gold ETF, gold fund of fund, because that is being regulated by us. So from a regulatory point of view, I think gold ETF, gold fund of fund clearly stands out. Also, if you see from a transaction point of view, while between gold ETF, fund of fund, and a physical gold, investors might think that let's take an example. Let's take exposure to a 100-gram gold coin rather than getting into a gold ETF. One thing we need to understand is the cost of ownership. Now let's do a fair comparison. While you are going to buy a gold, say 100-gram or a 200-gram gold coin, first of all, the jeweler will charge you GST at the time of buying, which is 3% basic custom duty and 5% basic custom. Sorry, 3% GST. 3% is the GST that he will charge to you. Then there will be markup because buying and selling prices are different. So you end up buying at a higher price and you end up selling at a lower price. Then 3% GST will be deducted at the time of selling. So on an average, that 50 basis point is the markup at the time of buying and selling. So cumulatively, it becomes 1%. 3% buying, 3% selling becomes 6%. So 6% plus 1% is 7%, which is your cost of ownership of physical gold. And after doing that, you don't know that whether you have bought actual gold of actual purity or not, because we have seen enough instances of say fraud despite being hallmarked, right? So purity impurity issues will be there. Then you are also, if you want to kind of keep it in store, then you have to also incur storekeeping charges, safekeeping charges. That gold that you have bought is also not insured. At the same time, you are paying 7% as transaction charges. Versus gold ETF, if you see in case of gold ETF or gold ETF fund of fund, they buy gold ETF only in a particular dimension, which is 1 kg gold bar, which is LBMA certified of 995 finesse only, which means there is no issue of purity, liquidity, anything, right? Secondly, while we buy gold ETF directly from bullion traders, I think our pricing are much better because we don't end up paying any markup charges because the bulk is higher and directly dealing with bullion traders. That is the second advantage. The third advantage is that as investors, you are not having or you're not getting the impact of GST, because the returns that you get is always net of GST, because we keep on buying and keep on selling. So GST gets adjusted against each other. So the NAVs that you get or or the returns that you get are net of GST. So again, the GST implication is not there. The fourth point is the gold, whatever gold that we keep in the for gold ETF is also 100% insured and also kind of kept with the custodians. So you need not to worry about the safekeeping, or you need not to worry about the insurance. So it is LBMA certified 995 finesse 1 kg gold bar, bought at most transparent prices, kept with custodians, with safekeeping, without any GST implication, and also being completely insured. So this is all advantage of gold ETF. And for that, what you are charging is, say, on a gold ETF, say roughly 50 basis point, and in a gold fund of fund, roughly close to 1% kind of a thing. So even if you are paying, say, 1% per annum, in the against physical gold, where you are actually incurring 7% kind of a transaction charge or overall cost of ownership, I think in gold ETF you are actually, that takes care of approximately seven years of your holding without worrying about anything. So that makes a very clear case for gold ETF, gold fund of fund. And anyways, digital gold, as I said, they are not regulated. You don't know, they are not backed by actual physical gold. And we keep on listening that some of the other gold Ponzi schemes keep on busting. So, and that is why regulator also issued an addendum, said that stating that digital golds are not being regulated by us. So we don't kind of comment on that. And our request would be investor to take exposure in gold via gold ETF, gold fund of fund. So I think that makes the thing very clear, a comparison between, say, gold ETF, gold fund, and digital gold.
Right. So thank you for beautifully explaining this, Sanket. I would just summarize. So gold ETF, silver ETFs are regulated by SEBI. They are 100% backed by physical metal, and we always uh, complain about the regulator or the government, but um, uh, SEBI as a regulator has done a wonderful job where each ETF unit is backed by real asset, which is not the case with the global peers or global regulators. Second, there is a difference between gold ETF and a digital gold. There are many platforms in India which are selling digital gold, but those digital gold is not regulated. Only gold ETF fund of fund are regulated. And SEBI has also issued a guideline that physical gold are not regulated. If you want to take exposure, take it through gold ETF. And the third thing, there are a lot of transaction costs associated with buying physical gold and silver, as well as with silver. There is also a storage cost associated with it. So it gives gold ETF or gold ETF fund of fund gives you exposure in the metals, and where institutions are trading with the bullion traders, and they also get better pricing without any impact of GST. So now, Ankit, coming on to silver,
Correct.
that is more hot topic than gold, and we have seen a crazy rally. And as a wealth management firm, we also gave a call on silver in May 2025 when it
Correct.
was almost at 33 USD per ounce.
Correct.
And we always look at what is gold to silver ratio. In May, gold to silver ratio was more than 100 times now, which has that ratio has come down to around 50 times. But there
Correct.
is and silver has a very different story than gold.
Correct.
Be-
Correct.
because gold over the last 50 years has proven a hedge against inflation, while silver has not been a very investor friendly asset class uh, over the last 50 years. But now the structural story is very different from what it was 5 years back.
True.
So what is the story that is structural supply and demand that is being created in silver, and how it is finding a place in an investor strategic asset allocation?
Correct. Now, again, I mean, we know that both gold and silver are also considered as precious metal. While gold is roughly, say, 94% precious metal and 6% industrial metal, in case of silver, the dynamics are little different. And that is what I'm showing in the presentation also. Roughly, this is little dated, but currently roughly 65% of the demand is industrial and remaining 34-35% demand is investment. So two things we need to understand first is that from a demand and supply dynamics, in terms of demand, roughly 65% is industrial demand and 35% is in investment demand. And in terms of production, roughly 81% is mine production and 19% is recycling. Now, there is a peculiar thing about, say, supply of silver is that in case of silver, the primary silver mining, which means mines that extract only silver, is only 27%. Remaining, say, 83% are silver as a byproduct, which means we are going to extract lead, zinc, copper, gold, and all of that. In that process, we are also getting silver. So the primary silver mining is only 27%, and remaining is, see, secondary silver mining or silver mined as a byproduct. Now, from a demand and supply dynamics, if we go and check, say, from last 5-6 years, first of all, we need to understand that this entire industrial demand that we are talking is linked to the green energy, clean energy initiatives, right? Where the silver is being used in solar panels, solar photovoltaics, on in defense metals, in AI, and all those things, which has led to all the green energy, clean energy initiatives. And that entire demand has come in last 5-6 years only. So comparing silver with previous rises and previous fall will be little off track because this entire industrial demand is very new for silver. Now, while this entire industrial demand was there for 4-5 years, why we are seeing a price recovery only in this year? Because on account of a structural supply deficit. Now, what I'm plotting here is the total surplus or deficit in terms of silver supply, which means supply less and demand more. So in case in the year 2021, that the when the entire industrial demand for the new industrial demand for silver started, that deficit was only 95 million ounces. In 2022, that deficit was 264 million ounce. In 2023, that deficit was 200 million ounce. Then in 2024, that deficit was 149, 150 million ounce. And currently, if we see in 2025, we have the exact number that deficit is close to 220 million ounce, which means net, if I actually add all of them, the cumulative deficit at this point of time is close to 1000 million ounce, which is as good as a year's supply, because on an average the total supply of silver is close to 1000 million ounce, where the demand is close to 1200 million ounce. So the current deficit is close to 1250 current deficit is close to 1000 million ounce, which is as good as a year's supply. And for any silver mining to start operation, it takes 8 to 15 years, which means while there is a deficit, there is no immediate supply relief, and which creates the story of structural supply deficit. On account of that, on the back of that structural supply deficit, the silver started rallying. So it moved from say $30-$35 to $50 to $60 to $70 to $75 or to $90. Till that time, it was all industrial demand, plus few central banks also started buying silver on account of their diversification. Because there was some rally in the silver, people also started buying as an investment demand in their portfolio, right? And this is how the rally started. But beyond $90, it was all speculation, because we know that people have a tendency to speculate a lot in silver, because everybody knows that silver is a highly volatile asset class. So beyond $90, it actually started rallying on account of speculation. Because if you see that entire journey of silver from 90 to $120 was in the range of 15 trading sessions. So there was no reason for silver to kind of move in that fast pace without having any change in terms of an industrial usage or investment usage. So that was entirely speculation, and the pace at which it moved on the upside, it also came downside, right? So in one day, silver corrected close to 35-37%, and after that, silver started correcting 3-4% and started trading in the range bound. But the important point here is that in terms of silver, when silver started falling, it actually, the moment it came to $70 or less than $70, we always see that there are buyers at that level, and that pushes the price on upside. Because in the month of February itself, in almost like last 10 trading sessions, we have seen the silver prices moving from $90 to $64, then coming to $75. And today, if you see, currently they are at $84. Yes, there is high amount of volatility, but if you see from an industrial demand perspective, that story remains intact. Nothing has changed. There is a structural supply deficit. There is a shortage in supply. Demand is constant. Demand is constant and increasing for industrial usage. While supply side, it is very limited. There is a structural supply deficit. So what we see is that silver will also have a strong momentum going forward, but with lot of speculation that will come in between the journey of silver, because people have a tendency to speculate more in silver also because it is cheaper. Right now, also think from a demand supply perspective, a scenario between gold and silver. Why you think gold is expensive and silver is cheaper? Right, while say gold prices are in the range of say currently it is say $5,100, while silver is only say $70-$80. Why? Both are precious metal, both you cannot manufacture. But why gold is expensive and silver is not so expensive is because of the availability bias, which means that while 1 kg of gold is available in the world, consider that only 1 kg of gold is available in the world, 10 kg of silver is available in the world, which means from a overall supply perspective, the ratio is 1:10. But from a price perspective, if you see 80 versus 5,100, so it is close to say 64-65 times. So today it is that, but ultimately once the gold supply is over, silver will also kind of take that seat. So some way or the other, it will converge. That ratio will converge. In demand, it is 1:10. In price, it is 1:65. So some way it will converge, and that also gives a very, very strong and positive momentum for silver. So in case of silver, also we actually ask investors to take a strategic call, come with an investment horizon of 3-4 years, and expect a decent return of 10, 11%, 12% only from silver. Anything that you get over and above is all complimentary. Have your investment horizon intact. Don't try to take tactical call, because silver is very, very volatile asset class. And if that story of silver of industrial usage keeps on increasing, we can see a strong momentum in silver. The only big risk that we see in silver is the emergence of something like a substitute for silver in terms of industrial usage. So if an alloy or any metal proves to be a substitute of silver, then the silver ka story will go for a toss for some time. Right. So this is about silver, a highly volatile asset class, but considering the current dynamics we see, or we expect a positive momentum going forward, but come from a strategic asset allocation point of view. Don't try to come from a tactical call, because it is very difficult to kind of take a tactical call, because the movements are very, very fast. Now, even if you see last 3 days, last three trading session movement of silver, I think on Wednesday, silver was trading at say $64, $65. It actually bounced to $64, $65, or it fell to $64, $65. And Friday closing was close to $84. So close to $20, right? Which is roughly 25% movement in just 2, 3 trading sessions. So you can imagine the kind of volatility that it have. So having said that, I think silver is also something which is very, very interesting thing. Or for that matter, I have one more suggestion, that if you do not want to time between gold and silver, or you cannot decide between gold and silver, you can also considering investment into something like a gold and silver combination. So there are funds which actually combine both gold and silver, say some in equal proportion, some in different proportion, and that is being managed in the scheme itself. So that can also be a good strategy for someone to take exposure into these precious metals.
Right, right. So, again, iterating what Ankit has mentioned, and we have been speaking to clients because silver has become a hot topic. That silver is a very volatile asset class, and uh, there is a structural story, and we are positive on silver, on how it is placed structurally from a long-term asset allocation perspective also. Uh, but people should be very cautious. They should not come with a trading mindset. Uh, and people who have lost money in silver. So if we see rally from say last year till now, the people who are at loss are the people who entered between January 9th, from January 9th till January 29th, because that was when the speculation was at maximum. Silver shot up from 80 USD to 120 USD in almost 15-16 days. And those are the people who entered when the speculation was maximum, and they are at loss. So it has to be someone who anyone who is coming, who is entering in silver, should come with a mindset of long term structure allocation of say 5%, 10%. Not, we don't recommend more than that. It's a very highly volatile uh, asset class, and uh, I jokingly, so you can think of gold as a large cap, while silver, not even small cap, it's like a micro cap. You can just the volatility is on a different scale. uh, so that's about silver. There are three ways you can take exposure. One is through a multi-asset fund, where the fund manager would decide how much he allocates into gold, how much he allocates in silver. And in a multi-asset fund, the fund manager has the mandate to take at least 10% allocation in commodities, in gold plus silver. That's the mandate. At least 10% would be there, but they can increase based on how they look at the market. Second is a pure gold ETF, silver ETF, and third is a combination of gold and silver ETFs. So these are the three ways through which you can build exposure. From a long-term asset allocation point of view, we are positive on both the metals. Uh, Gold certainly, from an asset allocation point of view, should be part of the portfolio, about 10%. Silver, again, around 3 to 5% can be built, but from a long-term asset allocation perspective. Anything else, Ankit, you
Yeah, Aditya,
might
just
want to
one
add?
point, that when we say multi-asset, right? Normally what happens is when we consider multi-asset, that is only 10, 15, 20% of our overall portfolio allocation. Now,
Correct.
for example, I have 100 rupees and I'm deploying 20 rupees in multi-asset allocation fund. And within that 20 rupees, 10 rupees will go to gold and silver, or 10, 15 rupees will go to gold, silver, or precious metals, which means my overall allocation is only 2, 3%. So while multi-asset is a good story to kind of play on this precious metal, but they do not do the entire justice of 10%. And that is why you need an additional top up of gold and silver via these gold ETF, fund of funds, and silver ETFs or silver fund of funds. And that is why, I mean, they are getting a lot of traction these days, because people have realized this importance of strategic asset allocation. And what we only need to understand is that these allocations are not for chasing quick returns. These are more long term in nature and uh, strategic call.
Right, right, right. Now, we'll open the questions. Anyone who has any question, you can just raise your hand. I I'll just unmute, and uh, we can take around two questions. Because we are running just very short on time.
Hey, can I go? They are
Yeah, yeah.
here.
Please go ahead. Please go ahead.
Okay, if I want to go for a lump sum, and that too on a multi-asset, so what should be? How should I go? Let's say once a year I'm putting.
Hmm.
Another is what should be the mix on the silver, gold, and equity debt if we go for that composition, or should I go heavy on metal side and less on equity? If
So,
you can
sir,
help me for next 1.5 year. Hmm?
one strategy is that you allocate all you allocate 100% to multi-asset funds, where the multi-asset fund will take care of the asset allocation itself, and it will allocate at least 10% to gold plus silver. And currently the multi-asset funds are also at about 15, some are at about 22% allocation to commodities, but they take care of the asset allocation themselves. uh, the second way is we are building a portfolio with a combination of multi-asset plus equity funds. Then we can add a gold ETF, gold plus silver ETF, so that your overall allocation to gold becomes 10%. Silver, we are recommending anywhere between 2.5 to 5% allocation, and that through multi-asset fund it works well, because there's a lot of volatility in silver. So from an overall standpoint, overall portfolio standpoint, 10% in gold, about 2.5 to 5% in silver. That is what the asset allocation we would recommend. This asset allocation can be built purely through multi-asset funds, or a combination of multi-asset equity plus commodities.
And what about crypto? Because crypto is also down, so it is more of a tactical way of putting in crypto to
So
fund a fund, I think.
crypto, we don't. It's not regulated in India at this moment, and uh, really don't have. We really don't provide view on crypto at this moment.
Okay, got it. Thank you.
Manik, please go ahead. You have a question.
Yeah, hi Aditya, hi Ankit, thank you. So,
Right.
my question is like, we have invested in Edelweiss Silver and Gold Fund where we have almost equally
Correct.
allocation. So,
Yes.
in the market, what I faced is silver was at around 4 lakhs, or maybe it was increasing like anything.
Hmm.
I thought to sell it
Uh,
to book my profit, but I face like, okay, I don't want to sell gold, but I want to sell silver because of different behavior.
Correct.
So I felt that difficulty there. So how do you suggest that why should we take that fund instead of taking it separate? Because I
Sure.
face that problem. That's a
Sure.
practical one.
Sure. Manik, that is the exact point that I was trying to make from the very beginning. That while you are taking a strategic call, you are not in the chase of making quick returns or moving into from one asset class to another asset class. So if you are taking a strategical long-term call, I think gold and silver fund of fund does the best of its service, because it is doing allocation between gold and silver and reallocation on a daily basis. So you are getting automatic profit booking, auto averaging on the same side within the scheme without having any tax implication, and you are getting an equal allocation of gold and silver at all point of time. However, while you are trying to exit from silver and not from gold, considering the behavior, which means it was more from a tactical allocation point of view. In such cases, we always recommend that those who want to take a tactical call in gold and silver should come into separate fund. We also have a gold fund of fund. We have a silver fund of fund where you can do your investment enter at any point of time, exit at any point of time. But when you are entering into Edelweiss Gold and Silver ETF fund of fund, our recommendation is that you should take a strategic call. Also, if you see the objective of gold silver fund of fund is to balance the volatility that is coming into silver and to give you the upside that is coming into silver and gold, right? So it is more something like a mix of, say, large and mid small cap fund. So when large caps are more stable, which is gold, mid and small caps are more volatile, which is silver. So the combination was to create something like a large and mid cap, where you have to buy composite large and mid cap and you have to sell composite large and mid cap. If you want to segregate between large cap and mid cap, you have to invest in different schemes of large cap and mid cap, and that is the suggestion. That if you want to do a tactical allocation between gold and silver and want to enter and exit at any point of time, do the separate allocation for gold and silver.
Oh, great. Thanks. One last question is, what do you suggest, like on the current levels, one should, for the strategic one should go with SIPs only, or lump sum and SIPs, or SIP right now and lump sum at what level?
So use a staggered approach. Neither use SIP nor use, say, for example, first of all, you need to understand that what is your current allocation of gold and silver if your
Healthy.
portfolio.
Yeah,
If
yeah.
that is less than 10-15%, then you have to align your portfolio, right? You have to increase your exposure to gold and silver, right? So let's take an example that currently your allocation to gold and silver in your overall portfolio is only 5%, and you want to take it to 10%, which means there is a 5% room. So that 5% use a staggered approach for next 6 to 12 months and do investment rather than putting in SIP. Because what happens, particularly in gold now, we have seen that the trajectory of gold is always upward moving with stagnation, upward moving with stagnation. It is not too much up and down like silver, right? So in case of gold, while the trajectory is always upward moving and stagnation, the rupee cost averaging does not work for you. That means SIP does not work for you. So in that case, use a staggered approach, make it to 10% and then start doing SIP. Because why SIP then? Because ultimately your other investments will also be in the form of SIP. So like other investment, the investment in gold will also move.
Okay. Okay, great. Thanks.
So thank you so much. Thank you everyone for joining in on Sunday and taking out time. And thank you so much, Ankit, for beautifully explaining the structural dynamics in both the precious metals, asset allocation, different modes of allocation. Uh, and thank you, everyone. We look forward to doing more such sessions with Ankit and his fund house in the coming period. Thank you, everyone.
Thank you, everyone. Thank you. Thank you.
And if you have any questions later, please reach out to us. Please reach out to our RM team as well, and we'll be happy to take it forward from there. Thank you.
Guys, do you have time for one question?
Yeah, tell me.
Yes,
You
please,
can do
please
that.
tell me, sir.
Yeah. So first of all, thanks very much, Edelweiss and Wealthy Nivesh team. Very, very insightful presentation, which supported by data and statistics. So I think there was one point which I wanted to raise is this gold and silver. We have seen the rally, but there is similar fluctuations or similar sort of rally happening in other metals as well, like copper and platinum. So those who are missed out in silver and gold rally, there is an anticipation that similar rally will happen in copper and other metals as well. So is there any way how we can invest in other metals except for gold and silver? Because I understand there is not many avenues to invest in other metals in India. So it will be helpful to get some insights on how we can get advantage of the other metals, even if there is a rally coming up in near future.
So if you see gold and silver ETF, SEBI has allowed, and we have ETFs for gold and silver. For copper, there are no ETFs, right? And for copper, since domestically there are no ETFs and no fund of funds, there are not too much of options that you can invest for proper copper, other than you can buy the physical copper of bars or bullions. If you want to use or if you want to invest into copper ETF, into say global ETFs, you have to use LRS route. So there you can invest into copper ETF. But from an Indian context, I think the only way to take exposure of copper is via MCX, where you can do the derivative thing, or you can take exposure through metal by buying actual physical metal. I mean, this is my understanding because it is also not available on the mutual fund side. We also have a limited understanding on that side.
So the multi-asset fund, it has only gold and silver as a part
Yes,
of the
yes,
asset,
yes.
right?
Right,
It doesn't have. Okay, all
That's
right.
not allowed.
Okay. So in India, as of now, there is no avenue instead of buying a physical gold or going investing in US market or other
Or you can
markets.
take MCX derivatives. I mean,
Okay.
copper contracts are available on MCX.
Okay. All right. Thank you.
Thank you so much. Um, Thank you, everyone. And uh, any questions, please reach out to us, our RM team, and we'll be happy to take it forward. Thank you so much, everyone.
Thank you so much. Yeah.